When you buy a car, the transaction is definitive. You hand over the capital, the keys are transferred, and the utility is yours to command. You assume the economics of owning a cafe function with that same linear simplicity. That is a fundamental error. Owning a cafe is not the acquisition of a predictable asset. It is the voluntary assumption of an engineered liability, a machine designed to consume your liquidity while the landlord, the suppliers, and the tax authority reap the asymmetric returns. You are not buying a business. You are entering a high-friction environment where every single cost variable is stacked against you. Let us begin with the entry cost, the price of the dream itself. The illusion of the entry cost. The average independent cafe in the United States costs between $80,000 and $300,000 to open. That figure includes lease deposits, equipment, initial inventory, branding, permits, and the critical first 3 months of operating capital. But here is what the brochure does not tell you. That number is the minimum viable threshold, not the realistic cost. Build-out costs alone, plumbing, electrical, ventilation, ADA compliance, routinely exceed estimates by 40 to 60%. A commercial espresso machine is not a domestic appliance. It is a $15,000 piece of industrial equipment that requires maintenance contracts costing $3,000 to $5,000 annually. The grinder, a piece of machinery most aspiring owners never think about, runs another $2,000 to $3,000. And if it breaks during a Saturday morning rush, you lose not just the repair cost, but the revenue from every customer who walks out. But it gets worse. The labor trap. Labor is the single largest operating expense for any cafe, typically consuming 25 to 35% of gross revenue. And unlike a software business where marginal costs decline with scale, cafe labor costs are stubbornly linear. Every additional dollar of revenue requires a proportional increase in labor hours. The minimum wage in most major American cities now exceeds $15 per hour. Factor in payroll taxes, workers' compensation insurance, and the hidden cost of turnover, recruiting, training, and the productivity loss during the transition, and your effective labor rate approaches $22 to $25 per hour. A small cafe with just 4 employees working 40 hours each consumes nearly $16,000 in labor costs every single month before the owner takes a single dollar home. And here is the structural problem. You cannot automate away this cost. A cafe is fundamentally a service business. The product is not the coffee, it is the experience of being served. Attempts to reduce labor, self-service kiosks, reduced hours, degrade the very value proposition that justifies your premium pricing. That is not the worst part. The perishable inventory problem. Unlike a retail store selling clothing or electronics, a cafe's inventory has a biological clock. Milk expires within 7 to 10 days. Fresh pastries have a window of 24 to 48 hours. Roasted coffee beans begin to stale within 2 weeks of opening. This creates a brutal optimization problem. Order too much, and you waste product. Order too little, and you run out during peak demand, losing revenue and frustrating customers. The industry standard for food cost, the ratio of ingredient cost to menu price, is 28 to 33%. But that figure assumes near-perfect inventory management. In practice, most independent cafes run at 35 to 40%, with the gap representing the silent drain of spoilage, overportioning, and the comped drinks given to dissatisfied customers. The commercial lease, your silent partner. And now we arrive at the single largest wealth transfer mechanism in the cafe industry, the commercial lease. A prime location in a major city commands $40 to $80 per square foot annually in base rent. A modest 1,500 square foot cafe therefore pays $60,000 to $120,000 per year before selling a single cup of coffee. And that is just the base rent. Commercial leases in the United States are typically triple net, meaning the tenant also pays property taxes, building insurance, and common area maintenance. These additional charges add 20 to 40% to the base rent. Then there is the percentage rent clause, a provision in many retail leases requiring the tenant to pay the landlord a percentage of gross revenue above a certain threshold. You are not just paying for the space, you are sharing your success with a partner who bears none of your downside risk. The lease term, typically 5 to 10 years, is a financial handcuff. If your cafe fails in year 2, you remain personally liable for the remaining 3 to 8 years of rent. This is not a hypothetical risk. It is the primary reason 60% of independent cafes close within their first 3 years. They do not fail because the coffee was bad. They fail because the lease obligation consumed them before they ever had a chance to reach break-even. The optimistic versus realistic scenario. Let us model this out. In the optimistic scenario, a well-located cafe generating $800,000 in annual revenue, running at a 30% food cost, 28% labor cost, and 15% occupancy cost. After all other expenses, insurance, marketing, utilities, maintenance, loan service, the owner takes home approximately $80,000 to $100,000. A respectable living, but not wealth. And that is the best case, the top decile of independent cafes. In the realistic scenario, the same cafe generates $500,000 in revenue. Food cost runs at 38% because of waste and inconsistent portioning. Labor runs at 33% because of turnover and overtime. Occupancy runs at 18% because of the triple net charges you did not fully price in. After all other expenses, the owner takes home less than $40,000, often while working 60 to 70 hours per week. That is an hourly rate below what they would earn as a store manager at a corporate chain, with none of the benefits and all of the personal liability. This is not a business. It is a job you bought. If you want more elite insights like this, like the video, share it with others, and subscribe for powerful, high-level content consistently.